Hello and welcome to CNBC TV18's Mumbai newsroom. I'm Sumaira Abdi and you're watching MF Corner. Two interesting topics today. Joining in first will be Mrin Agarwal of Finsafe India. She'll be talking about which is the right way for investors to get their MF grievances addressed. And a little later, Harshvardhan Roongta of Roongta Securities will join in to talk about STPs versus SWPs, systematic transfer plans and systematic withdrawal plans. What is the use and applicability for both? So first up, let me invite Mrin Agarwal of Finsafe India. And, the reason I asked Mrin to talk about this issue of grievance redressal is because increasingly, if you open a social media site, you're seeing a lot of queries going towards the asset management companies, and a lot of them are grievances. I couldn't get my redemption processed on time. Why wasn't my application accepted on time, and so on and so forth. So, I was wondering why more and more people are reaching out to AMCs through social media. Is it that the traditional channel is not working or not working well enough? So which is the right way to go about it? So first up, we have Mrin joining in. Hi, Mrin. Thanks very much for joining in. So what is the official way, the most practical way, official way to get your MF-related grievances addressed?
Good afternoon, Sumaira. And as always, lovely to be here today. So the first point of contact should always be the intermediary through whom you've invested. It could be a platform, it could be a financial advisor, it could be a bank. I think the first point of contact always needs to be the intermediary through whom you've invested. In case if you have made a direct investment, then of course, yes, you should reach out to the fund house, to the AMC with whatever grievance you have. And, there are many channels through which you can do it. You can do it through email. You can call them on the phone. You can, of course, visit them at their branches as well. But I think, the first thing is to actually reach out to the intermediary through whom you've invested.
Okay. Mrin, just a follow-up question on this. If you're reaching out to the AMC, do you write to them or, do you just visit their website, find a tab and contact them from there?
There are various touch points. So you could do it. If you have an account, then you can, of course, log in and raise a query. You can do it through email as well. You don't necessarily actually need to visit the branch at all.
So how do you escalate the issue if you're, say, not satisfied with the response provided by the AMC?
Well, you have an option as an investor to go and register your complaint on the Scores website of SEBI. And here what happens is that, again, you need to create a login ID and create an account, basically. And you need to mention the nature of your queries. There are some preset queries that are there. Of course, one of the questions that is often asked is that, have you already registered a complaint of this sort with the AMC? And ideally, what I feel is that only if you've not got a satisfactory response from the AMC, then you should go to Scores and register a complaint at Scores. So what happens is that once you do that, the complaint is analyzed by SEBI and they will check with the AMC. Once, of course, you provide what was the reference number with the AMC. And then they will get back to the investor on the AMC response. And typically, these complaints are responded to within 30 days.
Okay. The other thing is that, Mrin, and probably I should have begun by asking you this. What are the kinds of practical issues faced by investors? If somebody is watching this, hasn't thought of reaching out to an AMC, just wanted to understand what are the kind of issues for which you can reach out to AMCs and how do you get them resolved?
So the most common one is really about investor details not being correct. So, for example, mismatch in the spelling, that could be a very, very common one. Or, the email ID, again, there could be a mismatch over there. Other than that, now with a lot of investors transacting online as well, I think there are a lot of queries relating to online portals in terms of NAV allotment. So, you put an order on a particular date, but you got NAV of the next date and stuff like that. And that's also because of the fact that now the NAV allotment is on the credit of the funds, right? So again, the same issue with the redemptions. There could be cases where dividends have not been credited. And of course, the stamp duty related queries are there as well, where people are not aware as to why the full amount is not showing in the account statement. So these are the typical queries that are received, but most of them are to do with correction in the investor details.
Okay, so those who are watching, these are all the kind of, typical kind of queries which you can send to your AMC or alternatively to the advisor or distributor through whom you have invested. Mrin, ideally, what is the timeline under which these grievances should be addressed?
Well, from what I hear from the AMCs and in my own experience, I have seen that the timeline can range anywhere between 2 to 5 working days. Typically that's what it's supposed to be. And as I mentioned, if you do register a complaint on scores, then it's going to be within 30 days.
Okay. Are there cases under which would require that, a written complaint be mailed or sent by post?
I don't think so. I think everything can be just done digitally these days. I don't think that, unless there's this submission of documents, right? So for example, if somebody wants to change their bank address or their bank details, then of course they do need to provide the old bank check and the new bank check. So I mean, in these cases, when you have to submit documents, then of course you would need to send these documents. But per se, for the query over the complaint, you do not need to send anything by post.
Okay. As an investor, can we and should we track the number of complaints against, say, an AMC in which, I may have invested in some of their schemes? What does it tell me if, there is a significant number of complaints against an AMC, and what is a routine number?
So yes, you can track it. You can track it on the AMFI website. There is a tab called Investor Complaints that you can find there. And typically what happens is that every month, the number of complaints are uploaded. You can also see the number of complaints for the financial year, and you can also see under what categories these complaints are. So again, when I looked at it, most of the complaints were under the correction and investor details tab. And typically, I saw that most AMCs had the ratio of number of complaints versus folios to be less than 0.5%. So I think that's not a really bad number. And, considering the fact that most of these are to do with correction in investor details.
Okay, so let me ask you about that. Since you're saying that most complaints are to do with data correction, so what is a good way for investors to check and keep a regular track, say, of their account statement, of their data?
I think one of the things that I have personally found very effective is the NSDL ECAS statement that comes every month. And why I like this statement is because, one, it captures all your investments, like, for example, bonds, shares, mutual funds, sovereign gold bond. So everything is there. So even if you have a PMS, it gets captured over there, right? Everything is captured there in much detail. You also have a section that shows you the transactions that you have done for the month. And there is also a section over there that shows you that for each of the folios that you're holding, what is the mode of holding? So is it joint? If so, who are the holders? Is there a nominee? What is the email ID? What is the phone number that you have against this particular folio? So I find that to be a very, very useful statement where you can see everything at one shot. I'm sure for people who are investing through intermediaries and financial advisors, I'm sure that they would also be providing a very detailed statement. But if you want to do a cross-check and you want to check a statement, this is one option. The second option that you have, again, is to do a mailback of statement either from CAMS or from Carvi. So in CAMS, for example, under the Investor Services tab, you have this mailback of statement across all RTAs, right? And again, there you can do it based on transactions or based on whatever date you want to or whatever time period. And for a particular PAN, it will send you back or under a particular email ID, it will send you back all the accounts or the folios that you're holding with detailed listing of transactions. So actually, this is a very good way, and it's a very good hygiene check that's available for investors who have invested through anybody. It doesn't matter. But if you just want to check the veracity of your statements, this is actually a very, very good way to check it. And as I said, even bank details are captured out there. So you have one statement that is showing you all the information related to this particular folio. Also, I would like to mention, that's a good way to check whether all investor details are mentioned correctly or not. And of course, for capital gains too, you can go to the RTA websites, which is CAMS and Carvi, and ask for a mailback of your capital gain statements as well. So there are these tools, simple tools that are available to all investors today.
Got it. Mrin, thanks very much for joining in and for explaining this. So basically, you don't have to just rage on social media. There is another way to do it, and a faster way as well. Okay, on that note, we're going to take a quick break. But on the other side, we're going to be chatting with Harshvardhan Roongta of Roongta Securities. He's going to tell us the difference between STP, a systematic transfer plan, and a systematic withdrawal plan, and also when you should use which and which is suited for what kind of investor. Stay tuned. Hi, welcome back. You're watching MF Corner. Joining in now, we have Harshvardhan Roongta of Roongta Securities. And today we're going to be talking about what is STP and SWP, how they work, what is the difference, and how do you know when you need it? So Harsh, thanks very much for joining in. The first question, of course, is, or rather we can start by revisiting, exactly what STP and SWP stand for and how do they work?
Hi, Sumera. It's actually a very valid question. I'll tell you why. Because even today, despite having so many conversations around investing in mutual funds, we still have some investors come up to us and say, hey, tell us a good SIP scheme. So SIP is not SIP, STP, or SWP. These are not products by themselves. These are only a methodology, a mechanism to invest in a particular scheme. So the first thing we need to be very clear about this, that these are not schemes by themselves. Now, specifically talking about systematic transfer plan, the STP. So what is an STP? Now, STP, as the word says, is systematic transfer plan. This is a mechanism wherein an investor, asks his fund house to transfer money from one scheme to another scheme of the same fund house. So that is very important. So now, for example, an investor has a lump sum and does not want to invest in the market right away. What he does is that he invests his money into scheme A, usually I'll say probably a debt fund. It could be a liquid fund for that matter. Invest this lump sum into scheme A and then ask the fund house that every month or every 3 months or every year, whatever, at any interval, transfer a specific amount from this scheme A into a scheme B, which is of the same fund house. You cannot do this across different fund houses. So it's a systematic transfer plan, transferring money at a periodic interval from scheme A, usually a debt scheme, into a scheme B, which could be an equity scheme. Now, systematic withdrawal plan. Now, systematic withdrawal plan, the SWP, is actually the opposite of SIP. So SIP being a systematic investment plan wherein an investor directs the fund house to debit his or her bank account and invest money into a particular scheme. Now, SWP is exactly the reverse of that and the opposite of that. In this case, an investor has some investments already with the fund house. There is a fund value created, of which the investor then goes and asks the fund house to say that, hey, every month, remove an X amount of money, redeem an X amount of money from this fund and give it back into a bank account. So STP is a systematic transfer plan, SWP being a systematic withdrawal plan.
All right. Is this STP, the systematic transfer plan, necessarily only transfers between equity and debt, or is it my choice as an investor?
Sumera, the systematic transfer plan says that you can transfer between two schemes of the same fund house. It does not say that you need to invest or transfer only between a debt and an equity. Usually, this is a practice. I mean, that you will invest your money into one category of schemes, which is probably a debt fund, and then you don't want to time the market, etc. So what you do is then you systematic transfer in an equity fund. But there is nothing that strictly, prohibits transfer between two debt funds or two equity funds. So there is no such restriction as far as the mechanism goes.
Okay.
Systematic withdrawal plan, on the other hand, is not a transfer mechanism between two schemes. As I said, it is a withdrawal option wherein there is a redemption from your scheme at a specific interval and the money comes back into your bank account.
Okay, so you could, even choose to combine them, right? A STP and a SWP, if one was so inclined.
Yes, most certainly. I mean, STP serves another purpose altogether, wherein, from an investor's perspective, look at the profile, for instance. So an investor says that, look, I have the lump sum with me, but I don't want to enter the market right now because they're overvalued or I don't know which direction it will go into. So says, look, I'm an SIP investor essentially, but I have a lump sum with me. What do I do? So choice number one, keeps the money in the bank account and sets up an SIP. So every month there's an amount gets hit into your bank and the money gets invested into equity schemes. But he says, okay, going further, I don't want money lying in my bank account. Why don't you take it out of my bank account, put it in something which is non-equity? So this goes into a liquid fund, say, for example. And from there, automatically an STP transfers money from this liquid fund into an equity fund. So you're essentially coming into equities in a monthly basis, so you're not investing the lump sum in equity. So this is the entire purpose and for an investor type who does not want to invest the lump sum in equity. SWP, on the other hand, serves the purpose, say a retiree. I mean, they've accumulated corpus until retirement. So you have a nice fund value created. Now you don't need the entire money at one go. At the same time, you don't want to possibly remove your investments and keep it in a fixed deposit or something like that. So what you tell your fund house is that, look, I need, say 50, I have, say, for example, a 50 lakh fund value, for example. Let's take, for example, a person named Ram. Ram has about 50 lakhs accumulated in fund value. Now needs about 25,000 every month. So what he instructs the fund house is to say that, please every month redeem 25,000 rupees worth of units and credit it back into my account. So that will be an SWP. So so retiree needs the money every month. So this is what exactly the purpose of STP and SWP would be.
Okay. What about the tax implications for both?
Yeah, so that's a very interesting thing to know. So in an STP, in case of an STP, when you're switching out of a liquid fund going into an equity fund, so we take that as an example. In a liquid fund, you're essentially redeeming. So there is a redemption done in liquid fund and there's a purchase done in the equity scheme every month. So the redemption out of liquid fund is a debt. It's a debt scheme. So all the taxation relating to debt. So short-term capital gains, in case your holding period is less than 3 years and you've sold out, you redeemed out, and long-term capital gains in case there is a redemption after 3 years of holding. So there is an implication on the illiquid fund. Now on the equity side, you're investing in that month, you're investing in that particular date. So that becomes your date of purchase for future long-term capital gains or short-term capital gains calculation. So just to summarize again this part in case it has been confusing, you've redeemed out of liquid funds. So whatever short-term, long-term capital gains implication, you will have to pay that. And when you invest into equity, that particular date every month will be taken as your date of purchase for future long-term or short-term capital gains calculation. When it comes to SWP, you're simply redeeming. So there is a redemption of, in this example that I gave you, of 25,000 rupees. So there's a redemption of 25,000 rupees on those units, whatever has been your capital gains, either debt or equity scheme, whichever you invested into, there will be a capital gains implication, short-term or long-term. Now, just to very quickly tell you what is the short-term, long-term capital gain on debt and equity. So in case of debt, your holding period, if it's less than 3 years, then it is a short-term capital gains that you make. The tax that you pay on the profits is whatever your tax slab is, whatever is the marginal rate of tax. So if you're in a 10, 20 or 30% tax bracket, that's how you will pay the tax. In case it's long-term capital gains, which is more than 3 years of holding period, then the capital gains tax that you have to pay on the profits is 20%, but you get indexation benefits. In case you're redeeming or transferring out of an equity fund, then short-term capital gains is for a holding period less than 1 year, and the taxation will be 15% of the profits. And in case of long-term capital gains, holding period more than 1 year, the taxation is 10%. However, the first 1 lakh capital gains that you make is exempt from taxation. It's only for income earned more than 1 lakh of long-term capital gains in a year.
Okay. Harsh, just one final question. Is it, I mean, practically speaking, is it very cumbersome to set up an STP or an SWP? What is the procedure?
Well, Sumera, in fact, given everything going online at a click of a button, I mean, it is not at all complicated. It's just a very simple instruction that you're giving to your fund house saying that, please do this for me. And it's only a matter of choice. So if you're applying online, I mean, if you're investing online, or in fact, everything is in fact online now. It's only a choice that you have to say that I will set up an STP. So you just click on that tab which says a STP from scheme A to scheme B, or if it's a withdrawal, you set it up. In case you're doing a physical manual form filling kind of a process, it's just a very single form. So there's nothing complicated. It's a very simple, very effective, convenient way for investors to deal with the way they like their investments to be dealt with. So I think it's a very, very progressive step. Just remember, it is not a product by itself. I have to emphasize this again. Despite so much of conversations that we've had around this, we still have people believe that this is a product by itself. So that's not the case.
Okay, Harshvardhan, your points taken on board. Thank you very much for joining in to explain this. With that, we'll wind up on MF Corner for today. Thanks very much, and I hope you found this useful. Do stay tuned in. The team of Closing Bell joins you next.